I'm Josh Duvall, certified financial planner, chartered tax consultant from Duvall Wealth and Tax Planning. I hope you're having a great day. I've had a couple conversations with clients about the tariffs and the stock market and being down 14% from the most recent high, and if this is a good time to start buying. There's always a goal for every investor to be able to buy an investment that you want at a low price and eventually sell it at a high price. That's how you make money in housing markets, how you make money in the stock market. The challenge, of course, is knowing when the low periods are and the high periods are. So, looking at a 30-year time horizon, which I think is very reasonable for an average investor. Obviously, if you live long and hopefully you start saving, in your 20s or 30s, retire in your 60s, and live to your 90s, right? So you have kind of three 30-year periods that make up your life, and probably two of those 30-year periods are investment windows. So, it's a long time frame to be able to understand market cycles. And if we look at a 20% drop as being a bear market item, right? So that's kind of the rule of thumb. 10% from the most recent high is a correction, 20% is a bear market. There's only been a handful of those over the last 30 years. So you have 98, you have '01, you have the financial crisis, you have COVID, you have the inflation and rate hike in 22, and right now we're down about 14%. So if you look at 15% as your middle ground, there's been eight windows. If this number that we've had this year, ends up eclipsing that 15% mark, then there'll be eight different times that that's happened over the last 30 years. So roughly every 3 to 4 years, you have a period like this. Is it possible that the market goes lower? Of course. Yeah. I mean, global trade, if it shuts down significantly, if we have a drawn out trade war with China, if there's a geopolitical issue, as I've talked to my clients and had many conversations with folks, the market can go down 20% for any reason or no reason at all. And volatility is just the reality of stock market investing. That being said, if you're somebody who's had cash on the side and you're thinking, hey, the market's pulled back about 14, 15% from the most recent high, which was in February of 2025, as of the recording of this video, the third week of April, we're down about 14% in the S&P 500. So the question is, will that continue going lower? Or will that be, sort of close to the bottom and a good opportunity to buy? The only way to know that is hindsight, right? Hindsight's 2020. And so the only way to know that is by looking back after it's already happened. But if you're someone who's sitting on the sidelines thinking, hey, I have some cash that I want to put to work, it's hard to pass up a 15% sale, right? If I wanted to go in and buy, a new furniture set for my pool, which we're looking at, if I walked into the store and it was 15% off, marked off, I'd feel pretty good about that. Would I be bummed out if I found out that a week later it was 20% off? Yeah, of course. There's always the potential that there will be a lower entry point in the future. But the further you go, the less likely that is. All right. So as markets go down and retract, which normally the old saying is that the market takes the elevator down, but it takes the stairs up. Right. So things fall much more quickly than they recover. But the recoveries are broader and bigger and end up adding significant growth, which is what we've always seen, right? If you take any period over the last 30 years, the S&P 500 is going to average somewhere between 9 and 11%, depending on exactly the dates that you're looking at. We have not ever historically had a time period where we look back and say, wow, who would have known that the market would never have got back to X mark, X place on the timeline of the S&P 500, right? It's never happened. Now, maybe this is the first time in many, many, many decades where we say, wow, February 2025, who would have ever guessed that that was the high water mark, and it'll never hit that again in our lifetime. But that's something that I'm not betting on, right? I'm a stock only investor. I buy stocks all the time with all of my ongoing regular contributions into retirement and investment accounts. I'm not recommending that for you. Your investment program should be specifically tailored to what your goals and risk tolerance and all of those items are. But what I am saying is that if you're somebody who's had money on the market, money on the sidelines that you've been looking to get into the market, a 15% pullback is is a decent entry point, right? It's something that historically doesn't happen that often. And is it possible that this goes further? Sure. Looking back at 2022, the market pulled all the way down to 27% negative before it ended up finishing about 18% for the year as far as where it had gone year to date. Obviously, 2008 was a deep correction, 50 plus percent. 2020 during COVID was significant, 40 plus percent. So it's possible that that goes lower. Um, but in likelihood, what happens is that people look for an entry point. They're not satisfied that 15% isn't enough. They wait for it to go lower. It doesn't actually get down that further than that. And then they miss the upside coming back, right? So timing the market in general is not something that we recommend. It's not something that I talk to clients about. It's not a strategy, in my opinion. It's extremely difficult. And I would challenge anyone that has a perfect track record of calling bottoms and tops of any investment index, unless you have insider information for a specific stock, which is, insider trading is illegal. Other than that, I think that you're looking at an opportunity to be able to buy. 5 or 10 years from now, it'll be very difficult to pick on the chart what day I should have bought or not. Looking and just generally saying 15% down is an opportunity to get some cash in, I think that would be something that you could reasonably come to that conclusion. The next question would be, do you push all in at once or do you dollar cost average? And I'm a big fan of spreading out those contributions over a 3 or 6 month window. It gives you the chance that, hey, if things go down further, then you're happy that you haven't put all your eggs in that basket and you have the opportunity to pull the trigger with the rest of the money if the market does go down 20, 25%. If the market starts going up, then hey, that's an opportunity where you were able to get in at those entry points, and you can make a decision. Okay, you know what? I put in a couple contributions over the last 2 or 3 months at around 15% negative. Now we've already come back another 5%. It's only 10% down. This is a good time for me to just get everything in. Either way, hindsight is going to be the best indicator of what you should have done. No one has a crystal ball, but what happens when you push everything in at once is that any single unknown event can affect all of the dollars that you were contributing. And it's much more likely that markets react aggressively negative in a short time period than it is that they react that same way, but in the positive direction, right? Usually positive growth in markets takes a much longer time than a negative downturn. So it's much more likely that the negative effects that we've felt have been priced into the market with tariffs and trading, etc. Again, any unforeseen event, a nuclear bomb, a war, assassination. I mean, everything's on the table. Anything can happen, obviously. Um, but I think it's a likely event that pushing some money into the market over the course of 3 to 6 months would be a good opportunity to get dollars to be at work. So if that's something that you want to talk about specifically, again, this is not a specific recommendation. This is a general conversation around putting dollars to work when markets have pulled back a little bit. 15% is a great entry point. You'd be happy if you went to a store and bought something that you wanted and it was 15% off. That would be nice. And the same thing goes for the stock market. But for your specific situation, if you want to talk through that, please feel free to reach out. You can shoot me an email at josh@duvallplanning.com. And you can go on the website, obviously, and book a meeting for us to connect as well. Thank you so much. I hope you have a great day. Thanks. Bye-bye.